What I like about equipment financing, it's quick, it's fast. Typically, you're going to get an approval within 24 hours and funding within a few days. So it's very fast. And a lot of borrowers like this because it's just speed. And instead of doing an SBA loan where they're going to collateralize not only the business with a UCC filing, they're always looking for additional collateral. So if there's a collateral shortfall, that's why the SBA is going to look for additional assets that you may have. And now, a word from our sponsor of this episode. Honeycomb is transforming the way insurance is done. Their state-of-the-art technology is next to none. You can quickly enter in a few data points. Their technology goes out and gets you a quote within 5 seconds typically. They cover single-family homes, medium-sized buildings, condo associations, HOAs, landlord policies. That's their niche in insurance coverage. Their typical policy on average is 40% less than the competition. So if you're looking for an insurance quote, Honeycomb is your solution. Honeycomb is transforming the way HOAs and landlord insurance policies are covered. With their state-of-the-art technology, you can enter in a few data points and their technology goes out and can get you a quote within 5 seconds. So if you're used to dealing with the old school insurance providers, you have to answer a bunch of questions and it takes hours, if not days, to get your quote back. Well, with Honeycomb's technology, that's all changed. They're top rated insurance by AM Best. They're rated excellent. There's many advantages. They do single family homes up to medium sized buildings, and these are landlord policies. As a lender myself, I know the importance of having a great insurance partner like Honeycomb. So I strongly recommend you check them out and get a quote from them. Hello, on this episode, we're going to discuss franchise financing, all about franchise financing, the different lending and financing options available for people that are buying their first franchise, or maybe they're expanding and buying several more locations or units. What are the options to finance the franchise if it's a QSR, a quick service restaurant, the equipment or the machinery needed for the business? Right? We're going to talk all about what options are available. So I hope you enjoy this, and I'm going to share a PowerPoint here. So today we're going to discuss all franchise financing solutions, which acquisitions, equipment financing, remodels, rebuilds, new locations, inventory, accounts receivable, and working capital financing, startups. We're going to address all this and more in this presentation today. So what are some of the basic ways of financing a franchise? You got equipment financing. So there's equipment lenders out there that specifically specialize in financing all the equipment needed and the build out for your franchise concept. That's an option. You got SBA 7A and 504. Is your franchise that you're looking at acquiring, are they on the SBA directory as approved franchise? If not, maybe it's because they don't have enough units. Maybe they've never applied. We can dig into that. Sometimes it's advantageous for SBA financing. Sometimes you might want to do a combination of equipment financing with some lines of credit and working capital. We're going to talk about 401k rollovers. Sometimes if you have the right retirement account, you can actually roll that over and use those funds to purchase your franchise and get it started. We're going to talk about unsecured term loans and HELOCs. Equipment financing, flexible financing. Sometimes you can get $2, $3, $4 million, depending on the build out and the equipment needed. This could be for new or used equipment. Typically with equipment financing, they're only leaning the equipment they're lending on. Sometimes they'll do a UCC filing on the actual full business if they're doing build out and doing tenant improvements. What I like about equipment financing, it's quick, it's fast. Typically you're going to get an approval within 24 hours and funding within a few days. So it's very fast, and a lot of borrowers like this because it's just speed. And instead of doing an SBA loan where they're going to collateralize not only the business with a UCC filing, that they might take a secondary lien on a primary residence. They're always looking for additional collateral. So if there's a collateral shortfall, that's why the SBA is going to look for additional assets that you may have. So just be aware, SBA is an awesome tool. And we do a lot of SBA financing, but I want this to be about the different options you have. Now we're going to talk about the 7A and 504. The 7A can get up to 90% loan to cost. So you can build in the cost of the franchise fee, the cost of the build out, the cost of the equipment. With the 7A, you can also include working capital, and also you can budget in 3 months of employees' wages and things. So you can build out a good amount with the 7A. The 504 is just going to lend on the asset itself if there's real estate component or equipment component. So most of the time we're going to do a 7A because the 7A is geared for everything else. And you can even use 7A for real estate. But I'm just saying there's a lot more flexibility with the 7A. So is the franchise on the approved directory? If not, there's ways to get it listed on, but it is a process. Advantages of the SBA 7A specifically is that you can build in all the fees, right? The total project cost. So you're talking about franchise fee. You're talking about all the startup costs, all the hard costs, even the financing costs, even working capital and operating capital. We look at that number, that's the total project cost. Potentially you can get up to 90% finance. So that's pretty strong. That's why I like the SBA. However, going back to what I said earlier, if there's a collateral shortfall, they're going to look for additional collateral. So be aware of that. Anything with 25% equity or more in, they might go after and put a lien on that. Even if you don't have 25%, the bank may still put a second or third lien on a property. Let's talk about the 401k rollover. Let's just say you have a retirement account and it's an eligible vehicle that you can roll it over. You're going to talk to a specialist that handles the whole rollover process. They're going to walk you through. I'm not an expert in this in any means, but essentially you can roll over those proceeds and use that money for the acquisition of this business with all the costs, assuming you have enough in your retirement account. I believe you can do 100% of the cost of the funds. So I think you can roll over full retirement vehicle if it's the right vehicle. We're going to put you in touch with the right person to talk to that is an expert in this. I'm just going high level details of options that you do have or you may have. Let's just say now that you're interested in a franchise, they're not on the approved directory. There's not much equipment that you're going to be financing. It's a relatively inexpensive franchise to get going. Maybe it's $100,000. Potentially, if you're currently employed and have good credit, you can do an unsecured term loan. That would be in your personal name. And depending on your credit profile, your credit score, and your DTI, your debt to income, you can get upwards of $400,000. That would be high level there. What $50,000 to $150,000 is realistic, depending on the overall credit profile. That would be a term loan for 3, 4, 5, potentially up to 7 years. Approvals for this can happen very quickly. What's great about the term loans, there's no requirements on how you spend the money. So you can control the cost. There's no fund control. It's your money. It's your loan. You do what you want with it. And that sometimes expedites the process. You can also pair these products together, right? You can take your unsecured term loan and potentially still get an SBA loan and use that term loan to cover your out-of-pocket costs. You can even pair everything together, right? You can use these different resources depending on the total project cost of your franchise. You can use these different resources. So there's a lot of ways to do this. I'm just throwing out the ideas here, the basic funding solutions that we have. And then everything is unique and depends on the franchise you're buying and your unique situation. A HELOC, all right? Let's just say you have a lot of equity in your property, your primary residence or a rental property. You can most likely get an equity line on your property, and that's like a checkbook. You can write checks and you pay on what's dispersed. This oftentimes is a great for down payment for your SBA loan, or potentially you can use this for the franchise fee and then do some equipment financing. So if you have equity in your home, you can look at doing a HELOC. Typically, it's the lowest cost of funds that you're going to have, but it's not always the best way because you're using your personal residence, you're using the equity from your residence to invest in a business that may fail. Maybe it does really well. It might fail. There's some potential risk. But if you're sitting on a lot of equity, I do think it is a viable source that we can take a look at and see if that makes the most sense. So in short, as you can see, there's multiple ways of going about financing a franchise. And most people think SBA, and SBA might not be the best option. So I wanted this presentation or this episode of the show to be geared around, there's a lot of options. Where you are today, what you're working with, what kind of franchise concept are you buying into? Is it a quick serve restaurant? Is it a home service business where you need trucks and equipment, and maybe equipment financing would be an option, and paired with unsecured term loan, right? You see how we're putting these pieces together? So there's no one size fits all, but there are a lot of options out there. A lot of people don't know that you're able to finance the equipment and the build out with equipment financing. And so the advantage there is it's a lot quicker process. So if you want to get started quickly, that might be the best option. And then you can have repayments of 2, 3, 4, up to 7 years on this equipment financing, depending on the structure, the bank that's making the loan. And typically you're doing some kind of EFA, which is an equipment finance agreement. So you own the equipment when you're done making your payments. It's not a lease. You're not leasing the equipment. So there's different ways of structuring this. Anyway, every option has its advantages and disadvantages. I just wanted to put this episode out there because we just interviewed several people that own franchises and they're doing quite well. They're raising money from investors as opposed to going and getting debt. There's lots of ways of doing this. But our show is really geared to show you options on how to finance several different ways, how you can use some of your retirement potentially some of your equity in your home. And it really comes down to what will work the best for you. So I'm happy to discuss any of these options in detail. I know this was a kind of a scattered presentation, but I hope you enjoyed, and I look forward to seeing you on the next episode.